Okay, this is Mike Durr. I am the Kingwood Mortgage Guy, and we're here for our Tuesday night Homebuyer Webby. The Homebuyer Webby is a presentation I do every Tuesday at 6:30 p.m. and we'll continue doing these as long as I have people that'll show up and hopefully appreciate this information. What we're trying to do here is we're trying to help with particularly first-time homebuyers kind of navigate the hurdles that the industry puts out for the tougher loans and stuff. Well, just try to give you an insight so that you know the right questions to ask so that you're going to be served better. And that's our goal, is to serve first-time homebuyers better. And I want to thank you, and I do that because first-time homebuyers have been very good to me. It is 6:30 right now. And so what we're doing this week is we're looking at 5 or 6 of the most frequently asked questions by homebuyers. Now, I got this information from the Housing Urban Development, so these aren't the questions that I'm asked. These are questions that are asked consistently to the Housing Urban Development, which is a bigger outfit than, well, it's a national outfit. So I think that these might resonate with you. They're consistent with a lot of the ones that I get. So I wanted to start that. And so hopefully you can see my screen. It should say most asked questions, and most of you should be able to hear me. If for some reason you can't hear me, I'd like to do a sound check right now. And if you could just put a 1 in the chat box there to confirm that you can hear me okay. Thank you. Thank you. Good. All right. I guess I can be heard. So let's move on. The first part of this, next screen, there we go. I am the Kingwood Mortgage Guy. My name is Mike Durr. I can be reached at 281-348-9899. And my website is kingwoodmortgageguys.com. And you can also pick up a recording of the previous webinars we've done, plus some frequently asked questions. And we break it down into different categories. The big ones are credit, money, and then the FAQs. And so hopefully there'll be a treasure trove of information there. If you'd like to email me, my email is mikekmg@gmail.com. I am a member of the NMLS. My number is 318-989, and I work for Nation's Reliable Lending, and this just recently had my 4-year anniversary there. So anyway, hope that makes sense. And what I want you to do is I want you, if you have questions, obviously I'd love for you to contact me, and would go over any of this information specifically with you if that was appropriate. All right, so what we're going to cover tonight is the frequently asked questions from first-time homebuyers. And here are the questions. Why should I buy instead of rent? Can I become a home buyer even if I have bad credit? Are there special home ownership grants or programs? Should I use a real estate broker, and how do I find one? And then finally, how much money will I need to come up with? Now, I've got to share with you, if I were to do these in depth, we'd be here a lot longer than you or I want to be. So what I'm doing is I'm going to do a short take on each one of these. Hopefully it will give you some information that's going to be helpful and that you'll be able to use. And also will hopefully give you an opportunity to reach out to me and ask me any other in-depth questions that you might have. So that's the premise of it. And so let's get started. Why should I buy instead of rent? Well, as I put in this one, it's about the investment. So if you're renting, you are paying a landlord for the opportunity to stay in their rental property. Could be a house, could be an apartment, could be a condo, could be a townhouse, could be any of those. But what we found is, in most cases, when you're renting, you're not spending the same amount of money that you are buying unless you're staying in a really nice apartment. And it's possible that you are. The big part of it is that the apartment is considered temporary housing, and it's not considered permanent housing. Now, I do know that some people stay in apartments for years. And if it suits the lifestyle and you're comfortable there and you're getting along fine, maybe you love the neighbors and you know, love the apartment house, then stay there. You know, I mean, there's no reason not to. Here are some of the things that people seem to like about buying instead of renting. One, you get tax deductions. In this day and age, in our economy, tax deductions are pretty handy. You don't want to just pay all the taxes that the government wants. You want to have some tax deductions, and interest and real estate taxes are a couple of the big ones. The next one that I think is important is the home generally appreciates. So what happens is when you sell a home, when you leave and you're going to move somewhere else, you generally can come back with some equity, depending, of course, on how long you stay there and if you've made improvements or how the area has prospered or not. So generally, real estate tends to improve in value and it appreciates. The next one is it's yours to improve. So when you're staying in an apartment house, there's not a lot of incentive for you to paint and to put in new carpet and to add amenities to the apartment because you know you're not going to be there very long. And at some point in time, the next tenant would reap the benefits of that, or maybe it's the landlord or the owner of the property. So even if you're in a house, the landlord would love for you to improve the property, but you're not going to get any benefit from that except for the direct benefit of participating while you're there. So on a home, it's yours to improve. Another thing that people mention in this is you don't have to ask for permission to change things. If you're in an apartment, particularly, there are certain rules that you can or can't do. And then there are, even if you own a home, there's a homeowners association that you do have to comply with. But in most cases, that's they're pretty broad. So just realize that. And then one of the things I think a lot of people don't see is if you buy a modest home as your first home, and when I say modest, of course, that's relative to whatever you buy, but you can always keep that house and become the landlord. And then people are paying you rent as opposed to you paying rent. Now, I don't mean to minimize the effort and the time it takes to be a landlord, but it's just one of the options. And I don't know if anybody, I don't think first-time homebuyers think about that. And it's not unusual for people that are moving out of a house. Sometimes they will rent the house that they have had, and then they'll buy another house. And the income that they are offset with the cash flow is a positive part of their financial market, or their financial portfolio, if you will. And another study was done just recently, I saw this, that the cost of renting is 37% higher than buying, and that's based on some recent studies. So it's cheaper to buy. Now, that's not to say that there aren't a lot of things that go along with buying. There's other maintenance costs that probably aren't factored in there, and you have to be ready. I mean, it's not just something that you do willy-nilly. If you do that, you're going to be set up for not necessarily good things. But the bottom line is, in general, if you're ready, buying's generally considered better than renting. Buying's better than renting. So we'll go on to number 2. Can I buy a home with poor credit? Now, there are a lot of people out there that have had some kind of trauma in their credit before. So the answer is possibly, maybe, probably, perhaps, and it depends. I think the depends is the right answer because it depends on a lot of different stuff. But we here do a lot of work for people that have had some kind of credit trauma, all variations of those like. And I am a credit scoring, I'm not gonna, well, I'm pretty darn good at it. I can tell you what can be done and what can't be done. So that's the important thing. So what we're going to talk about a little bit different is how an underwriter looks at poor credit. And one of the big things that happens, and this happens to a lot of people, is was there a one-time event? And when I say that, I'm talking about the biggies. Was it a divorce? Was it a layoff or some kind of job loss? Or the big one is probably, well, between divorce and job loss and health issue. I mean, those are the three main ones that cause credit issues. So if you've had one of those, you tend to recover from those a lot of times. And the next question that the underwriter has is the borrower willing and able to make the payments that are agreed upon? And if you have a one-time event that you can prove or that you can show or that it's trackable, verifiable, and then you rally, and I think that the next group isn't. One thing I don't want to go on without looking at the different credit scores that I've got on here. This is basically an FHA credit score risk graph. The conventional version of this, the FICO scores are a little higher to qualify for a conventional loan program, but the FHA risk graph is the one that most people will go to after they've had some kind of trauma. So it's how most people with some kind of credit trauma would get back into the game and own a home. So just looking at those scores, those are credit FICO scores. These are not the same as Vantage scores, and I encourage you, if you have one of those credit cards or some service that prints you out a credit report, I encourage you to compare that, if you will, to one that's from the mortgage industry, because ours tend to be a little bit lower. Their scale goes up to 900, ours goes up to 850. Ours starts at 350. I think theirs does too. But I think that they have just it's a different scoring mechanism, and it doesn't really matter what that one is. What does matter is what the mortgage industry credit scoring algorithm is. So that's what that one is. I love this picture. This is a picture of a guy that's been knocked down, and this is what an underwriter is looking for. There are people that get knocked down from some kind of credit trauma, the ones that we mentioned just a minute ago, and then what they're looking for is they're looking for a borrower. It's okay if you get knocked down, but you got to get back up and you got to kind of get in it. So has the borrower had any late payments in the last 12 months? So they're looking for a recovery where you've been able to make all your payments in the last 12 months. They also are looking for a borrower that after this trauma that you've reestablished credit. And then they also are going to look to see what types of credit that you established. So it does matter. It's a little subtle point, but there are some types of creditors that are perceived negatively by anybody that lends you money. And that's another story. Has the borrower been able to build reserves? After one of the things that happens when you have a credit trauma like this is, man, you really have a what's the term I'm looking for? The thought process about going into debt again and going through that trauma is usually the last thing that you ever want to do again. And a lot of people will change the way that they operate. As a matter of fact, a lot of times people will say, you know what, I'm not going to do credit ever again. Well, that's not really the right answer. And I'm telling you that you just need to get back in the game, particularly if you're going to be borrowing money for a house. But having no credit is not necessarily a bad thing. I mean, there are people out there that will lend to you with no credit, but it's a good idea to strategically use the tools that are out there. And I'm one of those guys that can tell you how to do it without getting too crazy as far as credit stuff goes. So anyway, I thought that this was a good depiction of somebody that's been down. The old thing about if you fall off a horse, you get back up and ride right away. This is the same thing here, is you've got to kind of get back in the game. Okay, so next group we're going to talk about is what special homebuyer programs are available. And the ones I put on here, national, state, local programs, and the truth is these come and go depending on what's going on nationally in the state and the local area programs. So a national program would be one that wasn't, I think it was 8 years ago, 2008, I guess, when we were just coming out of the economic trauma. They wanted to help people buy houses, so there was an $8,000 credit that borrowers could get if they did an FHA loan. There were certain criteria, but a lot of people qualified for that. We did a lot of those loans, and there was, I think, a time limit that you had to live in the house, But with $8,000, I mean, that made it really attractive for people to buy homes at that time, and it was used. I haven't seen anything like that lately, but who knows? I mean, with a new regime, I'm not sure regime is the right word, with a new administration getting ready to move into the White House, and anyway, I don't want to talk about politics right now. State leaders, state opportunities. The state has certain things. We offer some of the state programs where they have a home buyer down payment program. And then local programs through Harris County. It could be Montgomery County, could be Fort Bend, could be any of the counties around here that may have special programs specifically for first-time home buyers where they want to encourage people to go into homes. There are certain areas in the cities that they're trying to get people to buy homes in. I'm going to tell you that these aren't always the kind of homes that you want to live in, but for those of you that are pioneers, this could be a good option for you. So just to know that those options are out there. I'm not going to go into a big list, and I'm going to tell you also that I'm not a big advocate of these programs. I've tried them a couple times, not had a terrific amount of success with them, but they serve some people. I know they do. So I just want you to be aware of those. One of the things about them is you always want to get pre-qualified first, because you're going to want to know what price range, what the correct price range is for you. You also want to check with one of the HUD counseling agencies in your area. And HUD is that what we talked about before, Housing and Urban Development. And then I want you to consider there is something out there right now that's considered a HUD home. And it's less of them now than what have been in the past. But a HUD home is a home, an FHA loan that has been foreclosed upon, that the HUD has come back, revitalized the house. I don't know if they did a bunch of renovations on them or not, but they have put them back on the market, and they will sell them to people for $100 down. And there probably are some good programs or good houses for people to buy. Now, again, less than what there used to be, because people are seeking out houses and being able to pay for them, as opposed to when this program was really in full gear, when there were a lot of foreclosures. But you just want to check around. And then I know Harris County has some kind of grant funds, and again, you just need to check with them and see which ones are appropriate for you, if you fit the income guidelines and the credit guidelines and want to live where they want you to go. So this could be something that would be important to some people, and I think that a lot of people benefit from these programs. So if you have any questions about that, obviously I'd love to chat with you about it and tell you how I really feel about them. Okay, should I use a realtor, and how do I find a good one? Well, first off, it's a very good idea to use a realtor, particularly when you're buying a house, because, well, let's just go over why. It's a good idea because you need to find, the challenge is you need to find a knowledgeable and caring realtor. They're going to be able to guide you. They're going to understand the local home pricing arena so that you don't overpay for a house. They understand the neighborhood. So let me tell you, there's a lot to know about each specific neighborhood. And if you get a realtor that has a lot of experience in, their farming area, they know that area well. They know the people that have moved in. They know the people that have moved out. They know what the schools are like. They know what the trash pickup is. They know how the post office works, how the fire department works, how the police work. They know a lot about that, particularly if you find the right person. They're able to negotiate on your behalf, and they'll know the quality of the schools and the safety in the neighborhood. And you know what the best thing is of all that is that when you use a realtor to buy a house, it does not cost you anything. Their service to you is free. So I can't imagine a reason why you wouldn't use a realtor when you're buying a house. So how to find a good realtor? Well, the way I would do it is I would ask friends and family of who they used and did they like them. One of the easy ways to do it is to do an internet search and find out who is showing up, who is serious about their business, that they actually have an internet presence. There's a lot that don't. I'd gather at least 3 names, and here are a couple questions that I'd ask them for sure, and there's probably others. This is not meant to be a complete expose on any of these subjects. This is kind of grazing over the top of them, but it'll give you the right questions to ask. First is, are they full-time? I'm believing that you're going to be served better by a full-time agent than you are with somebody that's working part-time. And there are a lot of men and women out there that do real estate in their part-time. They just do. And it's because it's a hard business to make a living at, particularly when you're just starting out. But I always like to ask that question, are you full-time at this? Second is, there are some realtors out there that focus on buyers, and then there's some that focus on listings. And so it's a good question to ask. Are you working with buyers consistently, or are you working primarily to sell other people's houses? It's kind of two segments of the marketplace, and it'd be good for you to get somebody that's a buyer's agent that knows a little bit more about what's going on with buyers. I always like to ask how many transactions in the last 12 months. This gives you an insight as to how busy they are, how good they are, and it's mixed, because if you get somebody that's super busy, they may not have time for you. And that's one of the questions that we're going to find out. But the next one is, how familiar are you with the area that you want to buy in? So if you're in the Kingwood area, but you want to buy in Cypress, then you would be better served by somebody that knows the Cypress area. But if you're going to buy in Kingwood, you want to find somebody that lives and works and knows this area very well. So that's the area you want to find out. Where do they hang out? What is their key area that they focus on? Like I said before, how many clients are they working with right now? And if they're working with more than 2 or 3, I'd be concerned. It's particularly buyers. I mean, they're out showing houses to 2, 3 different people, then they may not be able to serve you well if something comes up. Now, granted, it's good to have somebody that's busy because you know that they're good. But at the same time, there are some realtors out there that may just be too busy for you, and you won't be served as well. And then I guess the final question is, do you like them? Do you feel comfortable with them? Do you feel like they're honest and they have your best interest at heart? These are the kind of questions that you want, and it's kind of a gut feel, but you want to meet at least a couple, 2 or 3, and interview them, sit down with them, maybe even talk with them more than one time, and make your decision based on that. And obviously, I always would have a recommendation for you, since I'm married one of the better realtors in this area. So I'd like to introduce you to her too. Little plug for my wife. All right, how much money will I need to come up with? This probably is, well, you know what? I think a lot of people think about this, but they don't always ask me because they're afraid to ask, because they, in the recess of their mind, I'm not sure they really want to know, and it can be a little daunting. But we're going to spend a little time with this, not tremendous amount of time. But how much money is needed? Well, here's a list of items that you're going to need to fund in this process. Earnest money, usually 1% of the sales price. Now, earnest money is simply the money that when you put an offer in on a property, what you're doing is you're giving money to show the seller that you're serious about buying this property. The more money you put in earnest money, because there is a chance you could lose that money, is a message to the seller at how serious you are that you want to buy this property. So earnest money, I say the average is usually about 1% of the sales price, and I think that's a pretty good number for you to think about. The option fee is usually $100, and it allows you time to inspect the property. So what you'll do is you'll put an offer in, let's say it's a $200,000 house, and you put $2,000 in earnest money, and you give them $100 to give you a 7 to 10 day option period so that you can have the property inspected and do your due diligence on the property to make sure that it's going to be a good home for you. And within that time period, within that option period, if for some reason you find something that makes you nervous or you don't like, you can get out of that. The seller will keep the option money, the $100. You'll get your $2,000 earnest money back at that time. And that's not the only time that you can get your earnest money, but that's a good one. A lot of deals fall out after the inspection during the option period. Okay, the inspection fee. We talked about paying the $100 for the option fee to the seller. Now we're talking about paying an inspector $300 to 450, 325 to 450 for a full in detail inspection of all of the components of the house. These include, and this is not a complete list, but it would be the foundation, it would be the roof, it would be the electrical, it would be the plumbing, it would be the heating and air conditioning, and I probably forgot one in there, but you get the idea. They're checking to make sure that this house is in good shape, it's good for you to live in, and also would tell you how much might be needed to repair the things that they might need on that, or that are needed in the house. Next expense is an appraisal fee. And appraisal fees can be anywhere from $400 to $575, maybe even higher than that, depending on if it's an owner-occupant home or appraisal as opposed to an investment property appraisal. But appraisal fees are paid. Generally, that's expected from the borrower to pay that, and it's just another one of the little costs that come out of your pocket in the initial stage. Number 5 is the down payment. The down payment, the down payment can be whatever you want it to be, except for it's usually, if you're a vet or if you're in one of these special loan programs, the SETH program or a VA program or a USDA program, it could be 0. And those are great loans. FHA and conventional have a 3 to 3.5% down program. And then, of course, the conventional programs start at 5%. It's standard to put either 5% or 10% or 15% or 20%. When you put 20% down, there's some benefits that come along with that. If you put 25% down, particularly on investment property, the rates get a little better than they do even if you're putting 20% down. So the amount of money that you put down can make a big difference. The more you put down tends to be better. The next one is 1 year of homeowners insurance, and to put a number on that, I mean, it's a total guess, but I see insurance policies for the first year of anywhere from, well, I've seen them bigger than this, but $1,200 to, let's say, $3,600. And depending on the age of the home, the condition of the home, how many claims have been on the home in the past, and a lot of factors that go into that pricing. But it's just something that when you come to closing, you're going to be expected to fund and pay for the first year of the homeowner's insurance. So that's one thing that I'd rather you be prepared about. The next one is 3 months of the real estate taxes. Now this is assuming that you're not putting 20% down. If you don't put 20% down, you don't have to do this. You don't have to escrow at all. 3 months of the real estate taxes, the way that works is they want you to have enough money in the escrow account to pay the taxes when they come due. And what happens is, we're in October now, if somebody is buying a home today, then the seller is going to give the buyer a credit for the taxes from January 1st of 2016 all the way up through today, 10/25/16. So what happens is the money that you would be putting in your escrow would be enough to pay for the taxes that are going to be paid in December of 2016. You're going to have the benefit of the credit from the seller, plus the 3 months should give you more than enough money to pay the taxes, assuming that the tax cert came back with the correct tax numbers on it. So I know that probably rolled right and just caused your eyes to cross, but trust me, I can explain that to you in another more in-depth talk. Title company closing costs. There are some title company closing costs that you're going to pay, anywhere from $750 to $1,000, and those are for various and sundry things. I'm glad to explain those to you. And then a survey of $400. And you know what? I'm looking at this list, and I don't know how I forgot this, but there is lender fees also. If you're borrowing money, there are lender fees, and I guess I conveniently left that one off, but I wanted to put it in here. I definitely will show that to you in a later slide, but apologize. Whoops, that's my bad. All right, let's move on. Okay, well, here it is, the next slide. So what I did here is I put in the NRL closing cost, and I don't know how well you can see this, but it looks like it's coming through pretty good on the screen. But you've got the $14.95 is broken down into processing, underwriting, and doc prep and attorney's fees. So $14.95 is what a lender's closing cost would be. You don't pay for that until you close, but you do pay for it. Here is an example of third-party related fees: the appraisal, the credit report, the flood cert, appraisal management fee, $611, and then here are your title company fees. Some of these are optional. The $100 is an optional fee. I encourage people to pay it just because it's a good value. $400 is an average of what the title company escrow fee is, or I call it their referee fee. Courier and delivery fees are $50. Recording fees probably not quite as high as $150. And then the survey, if you're buying a house from a seller that has an existing survey that is usable, then you don't have to pay for that at all. So that really reduces the cost there. And you can see that's $1105. Okay, and we're back. Sorry about that. Getting calls. It's late to be getting calls. Okay, we did that, and then up here I've showed the estimated prepayments for interest and the tax and insurance escrow account. 3 months taxes, there's a $382 based on this particular program. 15 months hazard insurance. Remember I said, it's another mistake I made, I said you'd pay the first year in advance, but you also are going to put 3 months of money into your escrow account, assuming that you're escrowing for that. So you can see that number adds up pretty big there too. And then this just shows the payment, but down here at the bottom, whoop, let me go back to here. Down here it shows the closing cost from the lender, $1,495, the closing cost for the third-party related fees and the estimated title fees, about $1,700. The prepaids, that's this tax and insurance escrows here at $3634. In this particular case, there's a financed mortgage insurance. This is an FHA loan that I showed here. And in this case, let's see, this shows that the borrower, in this case, they've got $2,000 in earnest money that they put in advance. They're getting a seller credit of $3,000, and they're bringing to close $7,689. So that includes their down payment. That includes all their closing costs. They did good because they got this credit from the seller, which reduced them $3,000. Otherwise, it would have been $10,600. So a good example, and those open up some ideas for you that we should talk about. If you have any questions about how to get money from the seller to pay for your closing costs, it's a great idea. Okay, so we're running close to the end. So here's what we covered tonight. These are frequently asked questions from first-time home buyers. Why should I buy instead of rent? Well, we talked about that. Can I become a home buyer even if I had bad or poor credit? Yes, you can. Are there special home ownership programs that are out there? And yes, there are. There are national, there are state ones, and there are local ones. Should I use a real estate broker, and how do I find one? Well, we answered that, and the answer is absolutely yes. And if you can't find one, call me. I'd love to help you with one, or at least give you a referral for the one that I care about the most. And then how much money will I need to come up with? These are individual details, or they can be individual to the person. And one of the things that I do on a consistent basis is I do what's called a detailed mortgage estimate, which is what we just went over. And I do that. I will pre-qualify you and send you a detailed mortgage estimate so that you'll see exactly what the cost is, what the interest rate will be, how much your payment would be, and how much money you're going to need to bring to closing. And then we can see how you're going to get there, and if you have enough to do it right this second, right now, or if it's going to be a month or 3 months or 6 months. And one of the things I love to do is I love to answer the questions that first-time homebuyers have. So that being that, I am the Kingwood Mortgage Guy. Love to hear from you. You can call me at 281-348-9899, as a couple people have done tonight already. My email is mikekmg@gmail.com. And of course, you can always go to Homebuyer Webby, and look at this recording. What I do is I'll put it in there in whole as a previous webinar. I'm also break it up into a couple things a little bit smaller. You may not want to watch the whole thing over again, but you'll have the opportunity to break it up and see it in a easier format, maybe spend a little bit less time. I'm sensitive to that. So anyway, I think that is what I have for you tonight. I appreciate your attendance, and if you have any specific questions, I'm going to stop the recording and I am going to answer any question. I see that there are a couple questions in the checkbox, and I appreciate you coming and showing up, and I will talk to you for sure next week on the Homebuyer Webby.